Welcome to the Deep Dive. Today we're digging into Block's Q3 2025 earnings call. You probably saw the stock reaction after hours, quite a bit of drama.
Oh, absolutely. A real split reaction. You had strong operational numbers, but the market just hammered the stock in extended trading.
Exactly. So our mission today is really to unpack that. Why the punishment when, the underlying growth actually looked pretty good?
Yeah, especially gross profit or GP. That's what we really need to zero in on. Let's try and figure out what spooked the street.
Okay, let's start with the numbers that probably caused that initial reaction. The headlines, right? They missed expectations.
Right.
Revenue was $6.115 billion. Consensus was looking for something closer to $6.33 billion.
A noticeable miss there.
And adjusted diluted EPS came in at 54 cents, but the street wanted 63 cents. So yeah, misses on both.
And that EPS miss, that definitely set the initial negative tone, no doubt.
Yeah.
But like you said, look beyond the headlines. Look at the engine.
The gross profit.
Exactly.
Yeah.
Gross profit hit $2.662 billion. That's up 18% year over year. It actually accelerated.
Okay, 18% GP growth. That sounds solid. So where's the disconnect?
It's the flow-through. The market saw that accelerating GP, but then looked at the adjusted operating income, the AOI. It landed at $480 million.
Which is an 18% margin.
Right, 18%. And I think the expectation was, well, higher. They wanted to see more of that strong GP growth dropping down to the operating income line. That conversion seemed, let's say, underwhelming to investors.
Got it. So the growth is there, but the profitability conversion isn't quite matching up yet. Let's break down where that GP growth is coming from. The two big engines, Cash App and Square. Start with Cash App.
Sure. Cash App was really strong. Gross profit there was $1.62 billion. That's up 24% year over year. Huge acceleration.
24%. And monthly actives.
Reached 58 million. MAUs, 58 million.
That's a massive user base.
It is. But what's maybe even more impressive is the quality of those actives. Look at gross profit per monthly transacting active.
Okay.
That metric grew 25% year over year. It's now $94 per active.
Wow, $94. So they're getting users to do more than just send money back and forth.
Exactly. They're deepening the relationship. Think primary banking.
Mm-hmm.
Those actives grew to 8.3 million in Q3.
And accelerating.
Yeah, they mentioned it hit 8.7 million in October already. So the trend is up.
And they're adding features to drive that, like the pools feature.
Right, the social savings pools. So 1.5 million created by the end of October. It's all about building that ecosystem stickiness.
All right, so Cash App is firing on, well, pretty much all cylinders, it sounds like. What about the original business, Square? The merchant side, is it holding its own?
It really is. Square's doing well, showing some clear competitive wins. Square GP hit $1.02 billion, up 9% year over year.
9%. Solid, but not the 24% from Cash App.
True, but look at the gross payment volume, the GPV.
Right.
That grew 12% year over year.
Okay.
And management made a point of saying this was the strongest GPV growth pace they've seen in over 2 years. So there's real underlying momentum there.
Where's that momentum coming from? Is it just small businesses?
Actually, a lot of it is from moving up market. GPV from the larger sellers, those doing over $500K a year, that grew 20% year over year.
20% from large sellers. That's significant.
It's the highest growth rate they've had in that cohort since way back in Q1 2023. It shows their strategy to win bigger clients is working. They're taking share.
Is that driven by their sales teams?
Seems like it. Sales-driven new volume added, NVA, was up 28% year to date. And it's not just a U.S. story either. International GPV was up 26% year over year. So yeah, execution looks pretty strong on the Square side too.
Okay, so let's pull this together. Cash App accelerating GP at 24%. Square showing its best GPV growth in years, winning up market. The overall GP growth is 18%. Great. But we circle back to that friction point.
Margins.
The margins. That 18% adjusted operating income margin, what's holding it back? You mentioned costs earlier.
Yeah, the big one was the transaction, loan, and risk loss expense line. It jumped 89% year over year.
89%. Okay,
Right.
that's huge. That sounds like lending risk.
It is. It's tied directly to scaling up their lending products. Think Cash App Borrow and the buy now, pay later stuff.
So investors see that 89% jump and think, whoa, are they taking on way too much risk just to chase this growth? Is that the fear?
That's exactly the debate. Management's argument is, look, this cost is necessary to fuel incredibly profitable growth. Borrow originations surged 134% year over year.
134% growth in borrow.
Yeah, it's now at a $22 billion annualized run rate.
Mm-hmm.
And they stress the profitability.
What kind of margins are they getting on borrow?
They're achieving annualized net margins of 24%. even after accounting for the risk losses.
Okay, 24% net margin on something growing 134%. That is attractive, but how are they managing the risk with that kind of explosive growth?
Their answer is data. They lean heavily on their internal Cash App credit score. It uses near real-time platform data, stuff traditional banks just don't have.
So they feel they have an underwriting edge.
That's the claim. And they say despite the huge growth, the actual risk loss rates are still trending below their internal 3% target.
So the underwriting seems to be holding up, for now at least.
Right. And these borrow users are valuable. They bring in 3 times higher inflows per active, and they stick around longer, better retention than non-borrowers. It's an ecosystem play.
Okay, that puts the 89% expense growth in a bit more context. It's an investment cost for high margin, sticky growth.
Got it. What about any other margin headwinds? There was something mentioned about Square GP specifically.
Yeah, good catch. They mentioned a temporary headwind, 2.6 percentage points off Square GP growth this quarter.
Why? What was that about?
They called it processing partner operational flexibility. Basically, it sounds like they accepted slightly lower margins on some transactions this quarter.
To get a better deal long term.
That seems to be the implication. Secure better routing or terms with a key partner down the road. It hurts now, but they expect it to lap by Q2 2026. So, short-term pain.
Okay, temporary hit. So we see the growth engines, we understand the margin pressures in the investments. What are they building next? What are the strategic bets to keep this going? On the Square side, it's a lot about AI. They're talking about creating a virtual COO for sellers. Things like AI-driven order guides, even voice ordering.
Integrating AI deeper into the merchant tools. Makes sense.
And crucially, finally bridging the two ecosystems more directly. There's a new Cash App Neighborhoods feature.
Neighborhoods? What's that?
It links the 58 million Cash App users directly to Square sellers nearby. And the hook, a really low 1% processing rate for orders placed through the Cash App, that could be powerful network effect.
Interesting. Tying the consumer and merchant sides together with a pricing incentive? What else? Bitcoin's still a focus.
Oh, yeah. Big news there. Full Bitcoin acceptance is launching next week for Square sellers.
Acceptance, meaning customers can pay in Bitcoin.
Exactly. With auto conversion for the seller, so they don't have to hold Bitcoin if they don't want to. And importantly, Block says there are no associated fees for this.
No fees. That's aggressive.
It is. Plus, their Bitcoin mining initiative, Proto, actually generated its first, albeit modest, revenue this quarter.
Okay, so AI, ecosystem links, Bitcoin, lots of initiatives. Did this confidence translate into their forward guidance? Because the market reaction suggests maybe not.
Well, the guidance itself is actually quite strong, which adds to the confusion. For Q4, they expect GP growth to be over 19% year over year. That's $2.755 billion.
So continued acceleration from Q3's 18%.
Yes. And importantly, they guided for adjusted operating income margins to expand to 20%. That's $560 million in AOI.
20% margin in Q4. That's a step up from the 18% in Q3.
Exactly. And looking further out, the high-level goal they mentioned is to be approaching Rule of 40 heading into 2026.
Rule of 40. Okay, that's a key benchmark for software and platform companies.
Yeah.
Growth rate plus profit margin.
Right. So management is signaling confidence. But everyone's going to be waiting for the Investor Day on November 19th. That's where they need to provide the detailed framework for 2026, especially on operating leverage.
Okay, so Investor Day is crucial. We have this clear divergence then. Strong underlying growth, confident guidance, but a stock getting punished because the profit flow through wasn't quite there this quarter, especially with that big jump in lending costs. Why does this matter for you, the listener, long term?
It matters because it's the classic growth versus margin debate, right? Block is clearly winning in terms of growth velocity, especially with Cash App Borrow and Square Upmarket. But investors are saying, show me the money.
Show me that the huge investments, the sales expansion, the 89% jump in risk expense will actually translate into sustained expanding operating income in 2026 and beyond, not just get absorbed by costs.
Precisely. The Investor Day needs to answer that question directly. How does this high margin credit growth actually drive bottom line EBIT expansion?
All right, let's shift gears. Time for our thought experiment segment. This is not financial advice. We pitch an outrageous but plausible trade idea based on what we've just discussed. Remember, purely theoretical for your investment committee thinking.
Okay. Given this massive disconnect, the sell-off focused on the EPS miss and the risk expense jump, while largely ignoring the, frankly, incredible profitability and growth of Borrow.
The 24% net margin, 134% growth.
Right. The market seems to be treating that associated risk expense as just a dead cost, not the investment in a highly profitable, sticky product that it arguably is.
So how do you play that mispricing, theoretically?
Okay, here's the trade idea. You could consider selling the payment technology ETF, maybe IPA, as a hedge. Just covers you against general sector volatility or nervousness around fintech right now.
Okay, short the sector ETF.
And simultaneously, you initiate a long position in Block itself. But tactically, use out-of-the-money call options.
Calls? Why options?
Leverage and defined risk. And critically, set the expiration after the November 19th Investor Day.
Ah, so the Investor Day is the catalyst.
Exactly. The whole rationale hinges on that event. The idea is that management uses Investor Day to lay out a clear, credible path for operating leverage in 2026. They need to explicitly show how that high-margin borrow growth flows through to EBIT, reassuring the market about the risk management and the profit potential.
And if they succeed in doing that,
If they communicate that effectively, the stock could reprice pretty rapidly as the market digests that the growth is translating into sustainable profit expansion. The options provide the upside exposure to that potential repricing.
that's definitely a high-stakes bet on management's communication at Investor Day. Bold. So, wrapping up, Block delivered really strong GP momentum, no question, but it kind of failed the immediate profit flow-through test this quarter, setting up a critical Q4 in that all-important Investor Day.
Yeah, it's a pivotal moment. And the final thought maybe to lead you with is this. You've got accelerating primary banking users, 58 million people on Cash App. They've built a tool using their own data to offer credit profitably where traditional banks often struggle.
Yeah.
How much is that platform capability actually worth? Especially if they keep scaling it responsibly.
That data moat and the ability to underwrite differently, definitely something to ponder.
It's the core of the long-term story, potentially.
A fascinating question as we head towards that Investor Day. That's all the time we have for this deep dive. Thanks for joining us.